All right, HAT Jungle, let's get started here. Hopefully, I can get through without losing my voice. But this is the next module in the price action and technical analysis program. Last week, we talked about the option chain, kind of how we use that. And it's actually a, a part of support and resistance because we do find support and resistance levels through the option chain, where we find a big pocket of open interest, open option contracts, and it kind of gives us an idea of where we're likely to turn around, where we're likely to run to, and then turn around. But it's really good indicator. So now we're gonna move into more traditional support and resistance level indicators. So support and resistance are technical terms, and we use these in trading to identify prices that a stock will most likely be attracted to or reverse at. So you're gonna have, buyers or sellers sitting there, and they are a key component of technical analysis. It's a key component. So technical analysis is a process in which we are able to analyze past price and volume levels. While there are never any guarantees on what a stock's going to do next, right? This type of analysis is done to give us more focused information. Okay, just like the option flow, just because it's stacked up one way doesn't mean it has to do that. It's more likely to do that, but it doesn't have to do that. So somebody could easily come in and, hold on one second. My wife's freaking out about this stuff. Alright, so over time, a stock will establish price points where buyers or sellers came in and caused the stock to change directions. Meaning, if it was going down, buyers came in, overtook the sellers ran out of steam, or we ran out of sellers, and buyers just started buying up the price or the stock, and it started going up, and vice versa. If it was going up, sellers ran out of steam. The buyers ran out of steam, and then the sellers started taking over, and the price starts to go down. So the theory of support is based on the idea that there's a price that buyers consider attractive to buy at. And this is typically where you see the option flow or the option chain come in, where big money decides, okay, this is where the price is likely to go. This is where they're going to stack orders up. If it's a buy price, then they're going to have, a bunch of calls sitting there. Or if let's say they're short. Well, no, that I'm getting you confused, or I'm about to get you confused. So let's say a price is at a point where people think it's good to buy. We're gonna see that, and we're gonna see all of the option contracts are like, look, this is where we think it's gonna go. So they're going to buy these calls at this price, but then they're going to, as the price is going up, moving toward that price, they're going to sell. And so they're going to make money on it. Very few of them are going to hold it until that particular price. They're going to sell it beforehand to the unsuspecting retail traders. But whatever the case is, that's letting us know where we're going to run into resistance or where we're going to run into support. Alright. So, excuse me. So in both instances, an imbalance of supply and demand you're going to run into. So traders use different methodologies to determine support and resistance. Some may involve drawing trend lines, while others involve plotting moving averages over different time periods. Still others use volume and price together to draw conclusions. Some are calculated. It can get real. It can get real confusing at times, but it doesn't have to be that way. It doesn't need to be that way, right? So, but in order to use support and resistance, you first need to understand what makes stock prices move, so you can then interpret support and resistance from that mindset. And that's why it's always important, and why I always put a focus on price action. Because if you by understanding price action, you'll understand what makes stocks move, why stocks move the way they do. And then you'll be able to understand the impact of support and resistance on the direction of price. And you also need to know that there are different strengths of support and resistance. It's, sometimes I'll refer to these as weak or strong. But, weak levels are those that are expected to be broken. They're good profit targets, and you expect it to continue because you're not taking everything off there. You're, using it as a profit target, and you're expecting it to either get a hiccup there. You're selling into people that are going to be coming in on the opposite side, and however you would expect it to be weak. Now the stronger levels are the ones that are likely to reverse a stock. But again, there's no magic equation that's going to tell us how the price is going to move, how it's going to exactly move. So what makes stock prices move? And the simple answer is supply and demand. Okay, and that's true on the surface. But there are deeper forces at work. Okay, you've got people that don't give a damn about supply and demand, and they will manipulate it. Just like coming out of COVID, you had a lot of people manipulating supply and demand. they kept supply low so that the demand would outweigh the supply and they can charge more. It's a trick that's been going on for ages. Now, I just watched the movie again about Deepwater Horizon. And you know how BP spent all of this money supposedly, and then because of the spill, gas prices went up. But at the end of the day, BP made more money than it's ever made off the spill, which was deplorable. But it all boiled down to them creating a false supply and demand narrative. And the market can do that too. Okay, so that's something that you have to just understand and realize that, hey, I know the market works on supply and demand, but sometimes, a lot of times, there's going to be artificial supply and demand created. And I know I preach keeping things simple, and I know sometimes this can sound really confusing, and there's a lot of things you have to remember. But once you get it down, it's just second nature. You don't even think about it anymore. Alright, so it will be simple. So just remember, principle number 1. Stock prices are determined by the point where seller supply meets buyer demand. And it doesn't have to make sense all the time. So when it starts to not make sense, then you automatically know what's happening, and you can make the choice of, do I understand what's happening here? Let me get on the right side, or I don't like what's happening here and I'm not going to trade at this point. So you have those two decisions to make, and it all depends on where you are in your trading career. So there are 3 market forces that can affect the buy and demand of a stock. They're market sentiment, market fundamentals, and market technicals. Okay, the fundamental forces, we're looking at earnings, valuation, even inflation. I can throw inflation, I can throw news, demographics. I can throw all of them in fundamentals, to be honest with you. Technicals are going to deal with the chart and the trends on the chart and all that stuff. Market sentiment is based on emotional reactions brought on by these predatory algorithms or the news. So a lot of these things are intertwined. Okay, we hear bad news, the market, like the CPI numbers this morning. What happened to the market? It died. And then it kind of got bought up. People came in and said, hey, it's not as bad as I thought it was. And so they came in and bought it up. And that's where the market sentiment comes into play. So for us, day or short term, swing traders, we focus on technical factors more so and market sentiment. We're not so much into the fundamentals until we get into earnings, valuation. We don't deal with, but earnings, the news, all of those. Okay? So, one of the things that we use to identify support and resistance will be trend lines. Okay, technical analysis is centered around the theory that prices trend. Therefore, the use of trend lines is important for both trend identification and confirmation. A trend line that is basically is a straight line that connects two or more price points and then extends into the future to act like a line of support or resistance. Many of the principles applicable to support and resistance levels can be applied to trend lines as well. So let's take a look at, and I'm sure most of you already know this and you already understand this. But let's take a look at this anyway. So, basically, when we are looking at trend lines intraday, okay, we're looking at trend lines that are going up, trend lines that are going down. And we usually mark them, on the bottom. So they're going to look like this. Okay, we start marking the bottoms of the trend. Or if we're looking up, we may start looking at this. Okay. But all in all, we're looking at it, the price actually trending up or trending down. I don't use this a whole lot in day trading, other than to show, what's happening at certain points. So what we were looking at on Meta, and when I was looking at, we were looking at it breaking, the top of this channel. What I did was I looked at this and then I drew a trend line starting with the pullbacks. And the lows. Okay, look at this. Look at how we had the flat part here. We had the lows making higher lows. And so when that happens, we're using these trend lines to help us see what's likely to happen here. So when we're looking at this, it's like, look, we're not going any higher, but we're not really making lower highs. This was a slightly lower high, but then look at what happened. So in all indication, we were looking for a pop. And we did get it. We got it here and a big aggressive pullback. We got it here and then we got the pullback here. So, we're looking at this and we're letting the trend lines kind of help us determine the direction of price and where we're going to put, where we're going to, place our risk and all that stuff. So I don't draw these type of trend lines that much, but when you see me draw them, that's what I'm looking at. Now trend lines can be straight because what this is doing is it's showing me that we have a flat trend on the top and an ascending trend on the bottom. Usually that means it's going to break one way or the other. It's going to squeeze until it can't stay contained, and it's either going to break up, it's going to break down. That's what we're looking at on it. So, an uptrend line, that's the one that has a positive slope. That's what we drew on the bottom. And you got to have 2 points to start a trend. But I need to see at least 3 points before I can be confident in a stock trending. And it's kind of hard to do intraday. So the intraday trends, you're not going to see as well. Okay, but this is an intraday trend. It hit once, twice, 3 times. Now I'm confident in this. And look, it's still holding. It's holding it. So, we did dip a little bit below it, but we didn't confirm taking it out. It's still going. It's the wick. I use the wicks. But it doesn't have to be perfect. It just needs to show you a trend. And I can, basically you can see it. And you're going to get to the point like me where I can just see it. I don't have to draw it. I can see it. I'll draw it to illustrate it to you. But, I don't have to draw it to see it because I don't like a whole lot of extra stuff on my chart. Alright, and then same thing for the negative one, for a downtrend. Okay, let me see if I can find one that might have been going down. Like right here. And I'm not going to deal with the stock that has a wick like this. This is some type of volatility spike, and if it's that far out, I'm not dealing with it. Alright, so here we are. 1, 2, 3 hits. It's a legit trend line. Once we reverse it, once we reclaim this downtrend, look at what happens. It's one way. It's one of the ways that you could see later trader session reversals, because this thing is kind of chopping its way down, and eventually it hit bottom, and it can't really go anywhere. But these are things I can see this without having to draw lines. And eventually you're going to be able to see it too if you're not able to already. But those are the trend lines. So we talked about all of that. So next we come to pivot, support, and resistance. We use this a lot. For most other traders that you learn from, when you hear them talk about pivots, a lot of times they're talking about the process where analysts and traders calculate their pivots. They use data, past data, to calculate pivots. Once they've calculated the pivots, they plot these on the charts. And CAM pivots is one of those. CAM pivots are calculated pivot points, based on price and volume. But I don't use those type pivots. To me, those aren't as accurate as drawing the trend lines based on historical pivot points, as identified on a 52-week daily chart. Alright, so let's bring up the daily chart. So, looking at Meta here. Okay, the daily pivot points are where the stock changed direction. Wherever the stock changed direction, these are going to be my pivot points. So I'll start here at the top. Okay, here we made a high of 523.57. So this is going to be a pivot, 523.57. That's a pivot. Here's another one down here. 515.04. I'm not gonna stop and put the exact price, but you get the message. Okay, here I know this wick popped up higher than this candle. This is not a pivot. We're still trending down. The downtrend has not been broken. Alright, so that's still a pivot. So here, right here, this is a pivot. So what I'll do is I'll find a high price, which is what, 501.35. And so I'll put, that's another pivot right there. We can look at this too. 504, let's see, high 504 42. It's another pivot. So I draw these to help me determine, number one, where do we have potential support or resistance on the daily chart. Historical levels are pretty significant. So I look for that. And then I transfer these to my 5-minute chart to kind of show me where these levels are and what I have to do in order to take advantage of them or respect them, as levels. But these are what pivot points are. Now, where it goes down and it bounces, this is a pivot point, this is a pivot point, this is pivot. Just think about it. Anytime you get lost thinking about a pivot point, think about a seesaw or a teeter-totter. Remember those growing up? Hopefully you weren't as stupid as me and be sitting down and then have somebody try to jump on it to flip you. But basically, you had the teeter-totter, and then you had the thing that it rotated on. And that piece right there is the pivot. Or if you remember your physical science days, you remember this is a simple machine. This is considered a simple machine, but this is all it is. Whatever price came up and went back down, or if it went down and then turned around and came back up. That's it. That's all we're looking for. That's all we're looking for. So that's all. Yeah, fulcrum. Fulcrum. You're getting technical on me. But that's what it's a pivot is just that simple. Once a pivot point is established, you can't go back and change it. The pivot's there. It's not going to go back and change. that pivot is always etched in history. So to me, that makes them more reliable levels of support and resistance than trying to do these crazy calculations. So for most other traders that you learn from, that refers to pivot points. They're talking about the process where analysts and traders calculate pivots and the corresponding major support and resistance levels. Once they have calculated the pivots and major support and resistance levels that these pivot points represent, traders and analysts will then plot these on the charts to help them assist their trading decisions. And again, the CAM pivots, which is a math-based leading indicator, again, that's the math thing. I don't really like that. But you'll hear that. So I wanted to kind of bring that up. So when you analyze major support levels, the daily pivot levels play a hand in whether support levels are likely to come into play. So there are two ways to consider pivot levels. A fall through a pivot level would be needed to bring support levels into play. This tends to be the scenario, after a bullish run or, when the bears are in control. Failure to move through or back through the pivot level will bring support levels into play. That means the buyers are overtaking the sellers and they're looking to buy off that level, and that's going to be a support level. And then the resistance level is just the opposite. When a stock is going up and it runs into this previous pivot level and it can't go through, then you're bringing resistance into play. That means you've got more sellers up there, more people wanting to sell it or short it because they believe that's the highest price we're going to get to. And then it starts to come back. That's all we're looking at. It's just that simple. That's all we're looking at. Now, moving averages, again, we use those as support and resistance. A lot of times you see me use those as profit targets. You can look at the daily chart. You could see where oftentimes the moving averages act as support. They'll trade to it, bounce off of it, pull back to it, bounce off of it, pull back to it. I mean, you can't deny it. You can't deny it. So looking at the intraday charts, you can see it here again. Here we were holding the 9. We lost the 9 here, and now we're holding the 20. If we lose the 20, next on deck is going to be the 50. Okay, does this happen all the time? Yes. It tests the moving averages every day. It may not be the same moving averages all the time, but we will test moving averages every day. And all we have to do is look and see, are we going to confirm below it, or are we going to hold support and it move up. Once we lose this, this goes from being support to being resistance, because in order for a stock to get back through it, it's got to come from the bottom. It's going to be resistance. So this kind of gives us an idea of what the moving averages look like when it holds as support. We see this every day, which is why if we're short, this is always going to be a profit target. And if we're looking to get in a trade, we've got a significant support level if we're going to go long, or resistance level if we're going to go short, if it's up under that. We've got a defined level to base our trade off of. So, perfect. So we've gone through all of that. Alright, the linear regression channel. I know it's frustrating because a lot of people can't get it. If you don't have Thinkorswim. And none of the other platforms I've seen really has really embraced this, or the calculations are different. Alright, so this linear regression channel, you can see for the most part this acts as support and resistance. And then once we break through it, we typically have a decent move to the next level, because we're moving from demand to supply, or we're moving from supply to demand. So it just depends on which direction we're going. But this gives us a really good indicator of where the stock is going to move. You can see this whole day outside of this, once it came back inside, it traded through here for a day. And then yesterday, once we lost on Nvidia, we had a nice sell through. Okay, but look, we have wicks, and it wicks below, but it always comes back. It seems like it always comes back and closes inside the level if it happens. And you could see it really helps us knowing where support and resistance are going to be. There's a lot of algos that run off the linear regression channel. A lot of algos run off of it. And until I get told otherwise, that hey, we moving to something else, I'm going to expect the algos to be trading off the linear regression channel. Alright, so it's very useful. In my trading, is mandatory. Large institutions, funds, and algorithmic traders use this study to identify trends and trend direction. The use of the standard deviation gives them ideas as to when prices are becoming overbought or oversold relative to the short-term trend, and they plan their entries and exits accordingly. And we kind of do the same thing. Again, is any of this perfect? Absolutely not. But it happens more times than not, and that's all we're looking for, right? That's what we're looking for. Yeah, both 50 and 100. I just use different color blues. The 100 is the dark blue, the 50 is the light blue. But yeah, both of them. The signals are similar to moving average, but they're not the same. I think they're more accurate in terms of trend identification. Excuse me. The advantage of the linear regression indicator over normal moving average is that it has less lag than the moving average, responding quicker to change in direction. The downside is that it is more prone to chop in a not so trending market. But what we can do, and what I typically do during most days, is look to see what kind of window do we have between these channels. That typically tells me what kind of day I'm going to have. If it's tight, volatility is going to be short. You know, if we get some wide channels, then I'm going to feel better about it. I'm not sure. I got to plug that external hard drive back up because it's taken 2 hours. What the hell is that? I don't even know what that is. I have no clue. But you can see, and I can look very quickly and see 422.56 to 425.36. You know, that's about $2.75 move. No, I don't use anything like that. This is a straight Bollinger Band. Again, there's so many of those damn indicators that people use and add stuff to and change stuff and then say, hey, this is the newest thing. I just created it based on all of my stuff, and they'll sell it to somebody. And in a couple of months, it doesn't work anymore. The Bollinger Band is default setting. I don't change it. I don't change anything. The default setting, I feel, is the best setting. When people start messing with stuff, they tend to get off center. So everything's default. Only thing I change is the color, so that I don't get confused with anything. Alright, VWAP is something that we look at. The only time I use VWAP is on reversals. And you rarely hear me say anything about VWAP because it's inconsequential to me. But the pink, not the pink, this line right here is the VWAP line. Kind of the purple. That's going to be the VWAP. But again, I only use it on reversals. Alright, so the direction of the VWAP line is typically the indication of the trend, thereby using it as a de facto trend line. Just like moving averages and whatnot, you kind of use that as the trend. The 9 moving average is the short-term trend that I use intraday. The 5-day is a short-term trend on the daily chart. It's the most aggressive short-term trend indicator on my daily charts. Alright, so then we're going to have the psychological levels. These are the ones like whole and half dollar numbers, and a lot of those line up with the option chain. If you ever wondered why whole and half dollar numbers were really big, now you know. It's the option chain. It because of the way the contracts are sold, bought and sold, and how they or the price they represent, whole and half dollar marks are gonna be really critical to this. So to us, psychological is just knowing that, hey, whole and half dollar marks, people are gonna be hanging around, and the reason they're hanging around, now you know the rest of the story. It's the option chain. So often the price will test certain psychological levels, like whole, half dollars, even quarter dollar marks sometimes. Even quarter dollar marks. But these are often referred to as psych levels. Human tends to they tend to gravitate toward these prices. Whole and half dollar numbers. People like me with dyslexia tend to gravitate to those. And I think that's a big reason why I ended up gravitating to them before I even learned the significance of it. But we typically see a cluster of open interest around these levels on the option chain that creates a lot of support and resistance. So, in using support and resistance as part of technical analysis, you have to understand, and I'm sure you found out by now, the market has its rhythm. Okay, the market has rhythm. It's better to identify the underlying movement of a stock and then trade, rather than trade based on gut feeling. So that's why it's important to learn how to read price action, to learn how to read the chart, to get a feel for how the stocks move. All of that will help you determine whether you need to get in or not. Again, nothing's perfect, but if you do it more times than not, you're going to make money. Alright, and so, as I stated earlier, the most important type of analysis for day traders is technical analysis and price action. I need to add price. I skipped price action. And that is based on the theory that history repeats itself in terms of technical analysis. Price action puts you in the now, because you're working and you're working with what's happening now. Okay? And that's based on the historical movement of a stock. At the end of a thorough technical analysis, a trader identifies significant support and resistance levels which should be respected throughout the day. Okay, so the way this works is we find these technical levels, and then we're able to observe the price action as the stock trades around these levels. And what happens is when you're watching your trade, you're reading the chart, and the stock starts to act like it usually does around resistance or support levels, and you don't see anything on your chart, immediately the first thing I'm going to look at is, hey, did I miss a level? Okay, this stock is running into support or is running into resistance. I must have missed a level. Let me look real quick to see what's going on. Oftentimes, I have missed a level. So at that point, I've got a decision to make. If it's a weak level, I can give it, I can just let it test it. If it's a strong level, then I need to really at that point either close it out or trade out or take profit. But that's the way it works. The more hits you find on a pivot, the stronger it's gonna be. The more hits and the more recent. So let's pull the daily chart back up. Alright, so you can see right here, we've hit twice, basically. I mean, I'm not even worrying about the wicks because the wicks ran up. I'm looking at the body. The body price has rejected this daily level twice. This is going to tell me this is a relatively strong resistance in which this did pull back when it hit there. So I know. And then you've got the previous day's close price kind of sitting right above it. That can add some validity to it as well. But the more times you see these come together, the stronger you can kind of assume it's going to be. But you could look at how close all of these things are. Look at this. It took a while for it to break through, and then now it's basically support, right? And let's see, even if I moved it here, look at all of the price action that's kind of reacting to this level. There's no way you can dismiss that. All right. Does anybody have any more questions? All right, so hopefully if you're using Thinkorswim, what's the best way to calculate ATR6? You set it for, instead of having 14 candles or 14 bars, set it to 6. That's going to tell you how many candles it's going to use to calculate it. No problem. So I'm going to cut the video off and start uploading it.